Everybody, another exciting episode of the ConsumerFi podcast. I am pleased to be joined by Mark Baltuska. What kind of name is Baltuska, Mark? That sounds
it's Baltuska. It's Baltuska.
Baltuska.
And it's Lithuanian of all things.
Lithuanian. Okay, I knew you were somewhere in the Slavic-ish areas. My mom's family is from Croatia, and so everybody's name ends in an IC. Everybody.
Oh yeah.
You have no choice.
We got a lot to talk about, so we definitely do a lot of the Croatian stuff around our place. Cool. During Christmas and holidays.
Well, send me some gibbonitsa if it comes across your transom. I don't even know what it would look like if you send it to me, but I think it's some kind of delicacy. Anyway, Mark, welcome. Mark is with State National. All jokes aside, Mark's with State National, and we bumped into each other last week at a California Financial Services Association event, which was a real pleasure. Bucolic environment out there, Newport Beach, all outside. I got to tell you, Mark, everybody was so happy to be back outside and kind of mixing it up.
There were a lot of smiling faces, including mine. So it was nice.
Yeah. So I had the pleasure of meeting Mark and team, and I've seen the name State National, but honestly, I've been out of the game a little bit on the lending and operations side. So I asked Mark to kind of fill me in on what they do, and I have some experience with what they do. It used to be called the CPI. I think there's Mark would be calling it portfolio protection, but that's kind of the topic I wanted to talk about today because maybe we start at the beginning, Mark, but obviously want to know about you and your background to start, and maybe let's do that, and then we can dive into some of the history of how this product came through time and how it's evolved.
Sure. No, as you can see probably behind me, I'm a Kansas City Royals fan. I live here in Kansas City. Have been with State National for almost a dozen years now. And State National's been around for almost 50 years. We primarily were working in the credit union market for a lot of those years. But recently, here in the last couple of years, I guess, we made more of an effort in the finance company space, and we've been very successful at that. And we've come up with definitely some different products and programs that fit in that subprime space, just really particularly for those subprime lenders.
So let's peel that back a little bit. So when I hear portfolio protection, what does that really mean? Like just in terms of a basic definition.
Sure. Well, there's people go out there and they get their loan from whatever finance company that they work with, and part of their loan agreement states that you need to cover have full coverage insurance, and throughout the term of the contract. What our company specializes in is really two things: is tracking and insurance. So CPI, you need to track the insurance to make sure that borrower, keeps the insurance that they said they would keep. And if they don't, then we need to, CPI works where you notice the borrower, and you definitely different ways of doing that. We'll talk about that. And then if they, ignore the notices or don't do it, then of course, our primary responsibility is to the lender, and we're going to place insurance on that borrower. And then it would be a borrower-funded program where the lender would then collect it from the borrower. So keeping the lender protected. It does have borrower options to it where they get some something out of the deal.
Absolutely. Yeah, they go crash the whip with no insurance. They're gonna see it on their deficiency balance.
Oh yeah. Oh, for sure. So basically, we're in the CPI or portfolio protection, however you want to say it. We're in the business of mitigating risk. that's what we do for our lenders, period. That's what we do.
What type of lenders, really see a great deal of value out of this? I can think of a startup lender, somebody that that just can't handle, those losses. Maybe somebody who's transitional between 2 and 25 million portfolio size. And then the large guys, like Mark, I mean, I guess there's two populations, the folks that use it a lot, the folks that like it, or the folks that in your mind, hey, this fits in really well, you should be using it.
Right. We've probably got, nearly 700 clients throughout the country. And, there are, a ton of them that, that are smaller lenders, whether it's a finance company or a credit union or banks, they don't want to see those hits, when they have an uninsured loss, they feel it more than maybe the bigger guys do. Overall, if you look at the national average, the uninsured is about 12% or so. But when you
is that the entire market, or is that just for like non-prime or deep subprime? Like what is that?
So that's entire market. When you start looking at subprime, you're looking upwards of 30, 40, even higher percentages.
Oh wow!
Depending on how deep you go. If you look at like a buy here, pay here type of lender, they're going to be up there at 60% uninsured. But if you go more towards a medium-sized, lender that is definitely subprime, they're going to be more in that, 20 to 35%, depending on if there's a program or not.
Do you guys ever capture the uninsured population? Like, so we talked, 30 to 40% non-prime. And let's say I'm a lender, and this is specific to California because we met last week at the California event. Yeah. So I happen to know because a friend of mine's a personal injury attorney and does, automotive claims. He told me that Southern California has a very high percentage of uninsured motorists driving around. So here's the scenario. I'm a lender and I've loaned money out to somebody. They're driving their car down here in Southern California, and another uninsured motorist crashes into them, right? It's their fault. We would normally hit their insurance policy, but they're uninsured, so there's nothing to hit. And this person doesn't have, there's really nothing to go after. So I, as the lender, would normally go against them, but am I able to use the CPI to cover myself in a scenario like that?
Yeah, right. If you've got a guy that slams into you and okay, so you're the guy that doesn't have insurance either. So nobody's got insurance here. And if there's a CPI policy in place or one of our programs, whether it's CPI or portfolio protection, if something's in place, then yes, absolutely. Then the lender would be able to file a claim. And it's a lot like your own insurance, I guess. There's different levels of protection, that you can have. And a lender may say, look, well, let me back up. The biggest thing with lenders that I see are really three things. They want the insurance, portfolio protection insurance, to be affordable to the borrower. It needs to be collectible by the lender. And they want it to provide, a decent level of risk mitigation. Mm-hmm. And you can certainly, with today's portfolio protection, you can certainly hit all three. You can absolutely check each check mark. And it's almost like, the programs that we build for lenders, it's not a one size fits all. You asked who is in this, is it the little guy? Is it the big guy and all that? The answer is yes. It's all of them. Some of the very larger ones, some of the captives, they'll get into it from time to time. They'll maybe segment their portfolio.
Yeah.
Do it that way. A lot of the big banks, they're big banks. They got lots of money.
Yeah.
And they'll accept, they'll accept a lot of those losses.
Yeah.
But primarily, a couple of $1 billion portfolio would be on the higher end, and probably in the middle would be we got plenty of lenders that are in that $25 million range, but 100, 300 million right in there. It's kind of the sweet spot, it seems.
Yeah. The thing that I like about it is the offset to the static pool. You're not going to change anything relative to the unit losses, but you can bend the curve relative to the dollar losses. And that can be really meaningful when you need those static loss curves to conform with a certain standard in order to get you where you really want to go. And I'm thinking about getting lines of credit or something like that.
Sure.
Sure. Mark, in the past, we were talking about this. I wasn't involved in CPI super duper long ago, but we did have that in place with Pelican for a little while. And we were talking, and we were talking about just kind of where the market has moved, and there's been some innovations and all good things, including compliance. But, in the past, maybe there might be some confusion or maybe it was just tough times, or we were still getting our bearings. There was a bit of a bad rap on it a while back. Why was that? Because like I said, I wasn't really attuned to that, but the product has come a long way, and it's good to address that for folks who maybe had a bad taste in their mouth. I tried it and it didn't work for me.
Sure.
We kind of talk about that. Yeah.
Yeah, no, you're right. It's come a heck of a long way. In the past 20 years, it used to be very manual. It would involve a lot of borrower friction. A lot of staff time by the lender. There's so much that has been regulated in our industry. I mean, State National is the tracker, but we're also the insurance company. So when you talk about, can I do this? Is it am I compliant and all that? Absolutely. You just got to make sure you're partnering with the right company, the one that keeps you compliant, the one that's following each state regs and rules and all that kind of stuff. And in the past, I think it's been people think, oh my God, it's going to be really expensive, and how am I going to do this? How's my borrower going to afford it? Well, that's changed too, and it's definitely come a long way in the price regard, but really in the regard of how it's run, I guess, internally by us. And then externally with our lenders. I mean, we never had, 20 years ago, there wasn't automation that, where you can partner with your where your loans or your contracts are housed. Companies like yours, where we can automate processes of adding premium or taking off premium. Mm-hmm. One of the benefits of a portfolio protection program that sometimes lenders don't think of is you get protected really directly and indirectly. You're going to have the protection. Obviously, there's insurance on it now. Okay, so yeah, that's there. But indirectly, you're tracking. We are sending notices to your borrowers, and that's going to make a change. They're going to change behavior. It used to be where the old school was, we're going to send them a letter or two. We're going to stick something in the mail. We send them a letter. They won't open it. And, and that's what happens. Well, today, yes, we're sending letters because we have to. There's state regs and all that kind of stuff. We're filed by all departments of insurance, in each state and all that kind of stuff.
Sure.
But we're also, in what's called the notice cycle. That's when someone drops their insurance. And from the time they drop to the time that they're placed, that's a cycle in between. We're sending out emails to those borrowers. We're using text notifications to those borrowers, giving them really every opportunity to respond in every different way they can respond. So,
And that's
not all done that.
And that's all happening out of your shop. That's part of the service.
Right. So no longer are the lenders the ones that are having to, oh gosh, I better collect all this insurance mail that's come in.
Yeah.
That's old stuff. That disappears. We do that. That's our job. And the tracking comes with the program. You got the program, you get the tracking. So
nice.
it works out very well.
Nice. So you addressed one of the big questions that I had. So when we had engaged it, I think we were doing it during the days that you were saying they didn't kind of have it all really figured out. Administration was a bit of a bear. And to hear that the administration can be done on your side is certainly a big deal. And then you mentioned a little bit with system integration. And so are there any places that people tend to get hosed up on? I mean, the one that I'm thinking of is I got a notice. It said that the person doesn't have coverage. They've lapsed. And so I placed the CPI, and then the borrower calls me and says, why are you charging me for the CPI? Because I did have coverage. The information that you got was wrong, or I resolved it, like that next day. And so there's just a data lag. That to me was a bit of stickiness, because then I had to go and reverse billings and do this and that. Has there been anything to kind of smooth out that process, or do we have a better way to look at, confirming that prior to placing the billing on the customer's account to then have to reverse it, right?
Yeah, great question. And that's perfect, because in short answer is, there's a lot that's changed on that. So in regards to insurance, of course, so we're tracking. So if you got a tracker, you want to make sure they're doing it right. So over the past 20 years, you've got a couple of things. Electronic data interchange is EDI. Most of the insurance comes in that way. Probably in subprime market, probably 60% would come in via EDI. The rest of it is done via snail mail, because a lot of the companies, I call them the higher risk insurance companies, the smaller ones, maybe they're not subscribed to EDI, and that data doesn't transmit. So that's why, but they always shoot out insurance mail. And that's why it comes directly to us, to a post office, PO box, based in Dallas, Texas, where our company's located. And then you literally have people opening that mail, updating that insurance in real time, and it getting squared away. Now, and then you get the use of bots. I mean, AI has come such a long way. So we've got bots that go out and just ping insurance companies. And, because if we showed someone's uninsured, okay, most likely, with a lot of folks, they just switched, or maybe they're in the process of switching. The bots can go out, instead of us sitting there just calling around insurance companies, they'll hit a lot of them. That's growing every day. Right now, it's probably 8 of the top 10 insurance companies in the country. Now, I realize that a lot of subprime borrowers may not be with State Farm, right, but they'll be with folks maybe like the General or someone like that.
Right.
Those companies are actually coming into the stuff. We can do whatever with any company. It's what the other company can do. It's like automation with where your loans are housed. We're only as good as the other company is. Mm-hmm. But that's come a long way too. And you give them all those different ways to respond. So, you do the notice, you do the text, you do the emails, and then you give them, how would you like to respond? Would you like to call us? Okay, here's the number. Would you like to email us? Would you like to text us? You send in a picture of your ID card. That's great. And we'll update it, because we don't always know. Yeah. And there are some that we don't know. And if the borrower doesn't respond to us, at some point, those will happen, but not nearly to the extent that they used to. That's for sure.
Even kind of just rough speaking, when you look at take an average run of the mill. Let's say we pick 20. We're picking on people that have a $25 million asset under management. So a smaller company. They did not have a program such as this deployed. And I'm thinking specifically about the tracking plus the coverage. For an average company, let's say they walk in the door and they've got that 30 to 40% uninsured rate. After applying this and giving it a little bit of time to bake, are there some kind of general results like, hey, we tend to see they pick up, they drop that uninsured by some percentage? I mean, is there some kind of general rule of thumb? Yeah.
Yeah. Generally, you're going to collect insurance off the bots are going to hit a certain percentage. The outbound notifications will do something. The notifications basically will knock it down about 20%. Okay. So but it so depends on the lender, how deep and like I said, if it's a buy here, pay here, that's going to be probably a little bit different. Okay. But a typical subprime lender, you're going to have that indirect positive outcome, because that borrower that had been uninsured is now insured with quote unquote good insurance.
Yeah.
So we team that up with the portfolio protection program, that a company like ours has, and you're set up pretty good.
I think that a program like this, and I'm one of the folks, I'll be honest, I'm one of the folks that used it in the past. We were private equity funded. They had a great deal of knowledge of a variety of insurance products. And their point of view broadly on insurance in general was, we can get better returns somewhere else. I mean, these were very sophisticated financial individuals, and I'm sure they could do it, right? These are guys that are, that's their job is put money on turbo boost and make it cycle and just start making more and more and more and let the steamroller go.
Right.
So I look at today, and this is why I really wanted to have Mark on, generally speaking. So I speak with a number of different folks in a number of different lending situations, small to large, C-level down to the front line. And look, collateral values right now in the wholesale market are on the moon. And if I want to be competitive and buy, this used piece of collateral that I bought through wholesale 6 months ago has actually appreciated. And we're seeing this. So what does that mean? I have to advance more. I have to go potentially higher on LTV. But if the values are moving, then great. But I don't know that the values move that instantly. So I'm over advancing. The point I'm getting at is I may have the same unit loss that I was having before, but because I'm paying so much more for these vehicles, I may run into a huge severity issue where my loss severity just really kicks up. And I view something like this as a hedge, because I get asked by a lot of lenders, hey, I'm having to compete. I'm obviously doing well when I have to liquidate my repossessed collateral. But for the new guys that I'm buying, I'm concerned because I'm paying a premium now, but we're going to come down off of this moon at some point. And I want to make sure that I'm covered, because that piece of collateral is just not going to garner. It's not going to keep appreciating. Obviously, we can't keep doing that. But I view stuff like this as a way for people to wrap their head around a hedge for dealing with this issue. I mean, is this something that you have been hearing from folks and they have a concern with? Because I know you were talking about the credit unions, but it sounds like the traditional, FinCos, et cetera, are really kind of not waking up, but embracing this product.
They really are. They are embracing it, and you know why now is actually probably if you've thought about looking at a portfolio protection program, whether it be CPI or something of that nature, now is a great time to do that, because delinquencies are low. Repossessions are down, but it's not going to stay like that forever. I mean, we're in a very different time right now.
Yeah.
And,
This is a power. This is a power move. This is a power move, right?
Yeah.
If I do it while I'm bleeding, then if I were a state national, and I'm putting words in your mouth, I might operate with a little bit more skepticism. I'd be like, okay, well, there might be some issues in their operations there. Versus when you do it when the times are good, you can get your process laid out. You're not desperate. You're not operating out of fear, right? So now I'm operating out of power position. And look, this is only hitting the people that need the help as far as I'm concerned. And if the administration is handled really well and it's not providing a great deal of overhead to your organization, I say, why not? And like you said, you don't have to apply it to everybody. I mean, if you can apply it to certain geographies or certain credit tiers or what have you, that to me is a meaningful exercise to kind of look into, at least to evaluate, right?
Oh no, you can certainly, you can segment these things to really focus in on maybe where the higher risk is, depending on the size of the portfolio and everything. But probably the number one thing that I get from two things from lenders is they want to make sure it's compliant. Yes, we've checked that box and we'll show you, and we indemnify you for everything that we're doing, insurance related and all that kind of stuff, to make sure that, the program is good, that notices are, compliant, all that kind of stuff. But they want to make sure they're like, look, we don't want to, if they're thinking in the old school mentality of, oh my God, it was really expensive and all that, it's not that way anymore, or it doesn't have to be. It's almost like, look, Mark, I think my borrower could, my borrower said they keep insurance. I want to protect myself, but I don't want to cause an unneeded delinquency or repossession. So I think my borrower can afford a certain amount. Is it $30, a month? Is it an extra, $50 a month? We can work with you to craft specific, programs that will hit the risk level that you want to hit as a lender. And we'll tell you what that is. And so, if you hit that number and you say, I think, $50 is the number, Mark. Okay, this is what it can mean to you. This is the risk that we can mitigate with that number. And you'd be surprised. You'd also be surprised with the folks that, especially in the subprime world, they appreciate it. They're like, okay, so you're telling me that if I wrap this car around a pole, that I'm covered now because it's not liability. I understand that. So you get pulled over by a police officer and say, well, here's my CPI card. Yeah, it's not going to work. But you're telling me that I'm covered now, and you're not going to come after me if I'm uninsured, I wreck the vehicle, and all of a sudden I can't drive it to work anymore. Normally, I always say, hey, your borrower calls you up and says, come get it. Well, they probably never call. But, so the lender's not going to be faced with that. The borrower's going to be, have the satisfaction of knowing, hey, I'm covered. And heck, Joel, the way we pay total loss claims is NADA clean retail. So you're getting a good number. So that's the advantage of working directly with the insurance company.
I love it. Mark, this is great. Are you guys going to be, so I saw you out live and direct in Newport Beach last week. Are you guys going to be out and about at some of the other industry events? And if so, maybe give us a signal, or what's the next one you think you'll be at?
Well, here's your signal. Next week is AFSA Independence.
Fort Lauderdale, Florida.
Yeah,
Good.
Fort Lauderdale.
Will you have are you boothing or are you attending?
Oh yeah.
You guys have a booth?
We'll have a booth. Yep.
Okay.
Yep. We'll be there at the booth. Come look for me. We'll be there. We'll be at the AFS, the Auto Finance Risk Summit.
Yep.
We'll be there. And I think I just got an email on that yesterday or today.
Okay.
Just saying, hey, live and in person in Vegas. I can't wait to get back there.
Oh, fun. Nice. Yeah, that's a drive for me. I mean, it's a long drive, but I've done it. Yeah, I might need to go to that. I'll be at AFSA next week as well. So we'll go. And Mark, if folks are listening to this, maybe they're not going to AFSA. Look, if you're going to AFSA, say hi to Mark. He's not scary. Okay. We need to stop being scared of vendors and running away and just realize, there's people like, we just want to help, that's it. And if you don't want it, then that's fine. We'll share a drink and have a laugh, but, Mark, if people, maybe they're not going to AFSA, they want to get a hold of you. What's a good way to get a hold of you or someone on your team,
sure.
To see if this is a good product for them?
Yeah, you can always go to our website at statenational.com and click on lender services, and you can always get in that way. You can reach me on my cell, 817-727-7316. Or you're going to have a hard time spelling Baltuska, but in Baltuska, it's statenational.com.
I love it. Yeah, I love the cell phone thing, man. I put mine all over every article I write or on my LinkedIn.
Oh, yeah.
I get hit up with solicitations, but the thing is like I want people to be able to get a hold of me if they need me. So yeah.
Go to LinkedIn. I'm right on LinkedIn. Go there, shoot me a message, and we'll connect. That'd be great.
I'll spell it's MBALTUSKA at
statenational.com.
Statenational.com. Mark, I'm looking forward to seeing you next week. Folks, if you're going to AFSA, please swing by, let Mark know, you're a Kansas City Royals fan too, or maybe you hate him. He can take a little ribbing. He's good like that.
Well, what you don't see is, I think back there in the red, there's my Chiefs. We got a young kid named Pat Mahomes. I don't know if anybody's ever heard of him or not, but he's pretty good.
Never heard of him. Line's breaking up. Okay. Exactly. Mark, thanks so much for being on the pod today.
Thank you. Thanks for having me. It was great. I appreciate it.